Let me begin with a question. Have you ever looked at your portfolio during a market drop and felt a sudden urge to sell just to stop the discomfort? Not because your long-term plan changed. Not because the investment suddenly became terrible. Simply because the numbers were falling and your mind started searching for an exit. If that has happened to you, you are not alone. In fact, panic selling rarely happens to gamblers. It happens to intelligent people. People who read. People who understand markets. People who know exactly what they should do. And yet, when volatility rises, something powerful happens inside the body. Your chest tightens. Your attention narrows. Your brain starts searching for a way to make the discomfort stop. Today, I want to show you 5 behavioral patterns that quietly cause smart investors to panic sell. And there is a good chance you have done at least one of them recently, possibly without even noticing. But there is also good news. Once you recognize these patterns, you can design systems that make panic selling far less likely. Let us begin. The first pattern is simple: checking the market too often. Many investors experience volatility not through the market itself, but through constant exposure to it. You open your investment app several times a day. You keep financial news running in the background. You follow commentators who speak confidently during uncertainty. The result is that normal market fluctuations start to feel like personal threats. A small drop becomes something you watch repeatedly. Each check amplifies your emotional reaction. Eventually, the discomfort becomes strong enough that selling feels like relief. But here is the key insight. Frequent checking rarely improves outcomes. It mostly amplifies emotions. A simple solution is to create structured review times. For example, monthly or quarterly. You could also remove shortcuts to investment apps so checking becomes a deliberate action rather than a reflex. Within weeks, many people notice something subtle. Markets still move, but their emotional reaction becomes quieter. The second pattern is investing money that you might actually need soon. This pattern is extremely common. For example, money for rent, tax payments, school fees, emergency reserves. When markets fall, this creates immediate pressure. Because the drop is no longer abstract. It becomes personal. Suddenly, volatility threatens something real in your life. And under those conditions, panic selling becomes very understandable. The solution is structural rather than psychological. Separate money by time horizon. Short-term money, medium-term money, long-term investments. When these categories are clear, volatility becomes much easier to tolerate, because your immediate needs are no longer tied to daily market movements. The third pattern is this: confusing the feeling of being unsafe with actually being unsafe. This distinction is subtle but extremely important. When markets fall, your brain interprets the drop as danger. Behavioral economist Daniel Kahneman showed that losses feel roughly twice as painful as equivalent gains feel good. This is known as loss aversion. So when you see red numbers in your account, your nervous system reacts quickly. But feeling unsafe is not the same as actually being unsafe. Markets can fall temporarily while your long-term plan remains intact. One helpful technique is to deliberately widen your time horizon. Instead of looking at daily charts, zoom out to multi-year views. Volatility that feels dramatic over days often looks much smaller over decades. That simple shift can dramatically change your emotional response. The fourth pattern is not having a written investment plan. When markets become volatile, decision-making becomes harder. Without a plan, every market movement forces you to improvise. And improvisation during stress rarely produces good outcomes. A written plan does not need to be complicated. It could be a single page. For example, you might write something like this: I invest monthly into diversified funds for long-term growth. I expect volatility. I will not change strategy based on headlines alone. The purpose is simple: When markets become emotional, you are not inventing decisions. You are simply following decisions you already made when you were calm. Many experienced investors rely on written policies for exactly this reason. Structure protects you when emotions rise. Now we come to the most overlooked reason smart people panic sell. It is often not the market. It is life instability. When your life has low financial margin, markets feel more threatening. For example, high fixed costs, low liquidity, uncertain income. These conditions make volatility feel dangerous because there is little buffer. In those situations, selling can feel like emotional relief. Not because the strategy is wrong, but because the environment is stressful. The solution is not purely psychological. It is structural. Reduce fixed cost pressure where possible. Build liquidity buffers. Separate your identity from portfolio performance. When life becomes more stable, market volatility often becomes easier to tolerate. Let us recap clearly. Smart investors tend to panic sell when 5 conditions appear. They check the market too often. They invest money they may need soon. They confuse emotional discomfort with actual danger. They lack a written investment plan. Or their life structure has too little margin to absorb volatility. When these factors improve, something interesting happens. Markets can still move sharply, but behavior becomes steadier. And steady behavior is often the quiet foundation of long-term wealth. If this perspective resonated with you, comment the words calm plan. It signals that you are designing systems that protect you during difficult moments. And if you value calm, structured thinking about investing and behavior in volatile markets, subscribe. In the next video, we will design a simple volatility protocol so you know exactly what to do when markets drop without needing to think clearly while you are under stress. I will see you there.